we are now recording.
Great, thank you. So welcome and thank you for attending today's hearing. My name is Kathleen Birrane and I serve as the Maryland Insurance Commissioner. This is the Maryland Insurance Administration's second public hearing on specific carrier rate increases for long-term care insurance in 2021. Today's hearing will focus on rate increases that are now before the Maryland Insurance Administration. In the individual long-term care market, these include requests from Allianz Life Insurance Company of North America, which is proposing increases of 15% to 65%, depending upon the policy form and benefit period. And from Genworth Life Insurance Company, proposing an increase of 101.1%, but only for policies with lifetime benefits. In the group long-term care market, we are considering a request from Genworth Life Insurance Company proposing an increase of 103%. These requests in total affect approximately 2,641 Maryland policyholders. The goal of today's hearing is for the insurance company representatives to explain the reasons for the requested rate increases and to explain any new benefit reduction options. We will also listen to comments from any consumers or other interested parties that would like to speak. We really are here to listen and understand everyone's point of view. Let me just take a moment to introduce the members of the administration who are here with me today as part of our hearing. So first, Brad Boban, who is our Chief Actuary. David Cooney, the Associate Commissioner for Life and Health. Adam Zimmerman, our Senior Actuary. Jeff G., also Senior Actuary. And Craig I., who is our Director of Communications. Just a few simple housekeeping procedures today. First of all, when it's time for public comment, we will call on members of the public who wish to be heard. We didn't have anyone sign up to speak today, but if you are on the line and you wish to be heard, then just simply let us know that via the chat function. And if time and technology allow, we will hear from you at the end. With the exception of MIA staff, I just want to note this hearing is not a question and answer forum, but we are interested in hearing people's points of view. We did not receive public comments with respect to these hearings, these particular rate increases, but we will keep our record open until Wednesday, August 18th, 2021, for any additional written testimony that anybody wishes to submit. That testimony can be posted on the MIA's website, which is insurance.maryland.gov on the long-term care page. The long-term care page can be found at the MIA's website by clicking on the long-term care tab located under the quick links section on the left-hand side of the homepage. And frankly, if you're confused, then Craig I. will post his email address in the chat function and you can email it to him and he will assist you in getting it posted. I will remind people that this meeting is being recorded. The recording also will be posted on the MIA's website. And of course, please stay on mute unless you're speaking so that we can assure the quality of the sound throughout the hearing process. Anytime that you're speaking, whether you are a company representative or a interested stakeholder, if you would just please state your name and your organization clearly, that would be very, very helpful. So with that, in a second, I'm going to turn it over to the office of our Chief Actuary and Brad, and to talk a little bit about sort of the MIA's approach to long-term care reviews in general and any particular comments that he wants to make about these particular rate requests. But I would like to frame that just a little bit by pointing out that as the MIA approaches any rate request changes by long-term care insurers, we strive very hard and in a very detailed fashion to really balance between, on the one hand, recognizing the impact of premium increases on policyholders and what that means, and the concerns about potential reductions in benefits for a product that people rely on very heavily during times of their life when they feel the most and are the most vulnerable. We need to balance that against the need to keep companies solvent and to keep them healthy and to assure that there are sufficient funds in place to get claims paid, and not tip companies over into a place where ultimately they're heading into an insolvency and then really nobody wins because the only assets or the only resources that are left are guarantee funds, which is not something that's ideal for anybody. So, none of these companies are in that situation at present, but we are very, very mindful of what the issues are with regard to projections that turned out to be inaccurate, and the need to assure that the rates are sufficient and are adequate enough to assure that the company is going to be able to meet its contractual obligations in the long term without overcompensating with super conservative projections, and assuring that the companies, at least from Maryland's point of view, share in the consequences, if you will, of the projections, the poor projections, or the inaccurate projections from the past. So with that bit of a framework into how I look at these rate increases, let me turn it over to Brad and ask you to get us started. You're on mute.
Sorry about that. Thank you, Commissioner. Thank you for the introduction. And hi, my name is Brad Boban. I'm the Chief Actuary. This is my first long-term care hearing as Chief Actuary. As the Commissioner alluded to, these filings demand a very fine balancing act. And my predecessor, Todd Switzer, I think set up a framework where he very rigorously and thoughtfully looks at the issue from all sides and considers both the impact on the policyholder and the financial needs of the insurance companies and the need to have premiums adequate to cover claims, which are coming in much higher than any of these policies were initially priced for. That's driven by a variety of assumptions. And inherently, all of these filings are very long-term filings on the order of 50 to 60 years. And, there's a lot of uncertainty in setting projections that long. And, there's a lot of sensitivity to assumptions. And so, we really are doing our best to, look at the whole range of possible outcomes and to appropriate balance, the need to have premium cover claims, even in moderately adverse scenarios, but also the need to shelter our policyholders from excessive rate increases. In this market, we have, been receiving a steady rate increase requests. In 2020, we approved over 44 rate filings, impacting 50,000 Marylanders. The average aggregate request was 70%, and the MIA approved a 31.5% increase. 2021 year to date, we have approved 12 filings that affect 26,000 members. Originally, carriers were requesting an 88% increase, and the MIA has approved a 25.6%. As everybody on the line may or may not be aware of, Maryland has an annual cap of 15% per year for any rate increases. So when we're talking about approving a 25.6% average increase, it's understood that that's phased in over multiple years. And the increases talked about for today's hearing, which the Commissioner had mentioned, range from a low of 15% all the way up to 103%. That would be phased in the 103% over a 6-year period to stay under the 15% cap. Another thing that we have been monitoring and continue to receive updates from the carriers on is the impact of COVID on these claims costs. Carriers have definitely reported a COVID impact observed in 2020. In general, a reduction in claims incidents and a temporary increase in profitability. But as mentioned earlier, the fact that these projections go out so far into the future, it's really the long-term assumptions and lapse rates and claims rates that really drive the projected lifetime loss ratio. And so right now, the longer term impact of COVID is projected to be limited, but we are still, actively monitoring the situation, and we'll continue to ask carriers throughout the rest of the year and into next year to tell us what they're seeing, tell us to what extent claims rates are reverting to what they were before the pandemic. And in general, for the specific filings that we're looking at, as the commissioner said, this impacts 2,641 Maryland residents. These policies were sold over a wide period of time. The oldest policies under review were, sold from 1988 to 1999. The newest policy was sold from 2010 to 2013. All rate filings under review are closed to new business. These rates are only going to be impacting existing members and their renewals. And another thing to be mindful of is that each individual member has a 1-year rate guarantee. So even after rates are approved, a specific member might not might not see that rate increase until the following year. If rates start getting, updated in November or December of this year, some members are not going to have that increase till November of next year. In general, I want to save any comments on specific filings for the question period. So I would say that's my overview. And so I'll turn it back to the commissioner to introduce the carrier speakers.
Thank you, Brad. So the first carrier that we will hear from today is Allianz Life Insurance Company of North America. And we have Scott Laska with us to talk about the rate filing. Mr. Laska.
Hi, can you hear me all right? Okay, yeah, I know we've been doing this for over a year, but still want to check. So thank you. As you mentioned, my name is Scott Laska, and I'm a long-term care actuary at Allianz Life Insurance Company of North America. I'm in good standing with the Society of Actuaries and the American Academy of Actuaries. I'm joined on this call by Jennifer Willett, counsel to Allianz Life. I'd like to say thank you for reviewing our filing and having this hearing today to give us the opportunity to discuss our long-term care filings, which are currently pending with the MIA. And personally, thank you, Commissioner Birrane. We understand that long-term care rate increases are difficult for our policyholders and difficult for insurance departments to balance the impact on their constituents with maintaining a private market for long-term care needs. So we appreciate your time on this matter. We are requesting a rate increase on our Generation Protector and Generation Protector 2 products under policy form numbers 10-P-Q-MD and 11-P-Q-MD, respectively. These forms were sold in Maryland from 2004 to 2010. This rate increase would impact around 973 of our 1,589 Maryland policyholders. We are currently requesting an average rate increase of 44% for the Generation Protector policy form and 25% for the Generation Protector 2 policy form. And the level of the rate increase varies by the policy's benefit period. This filing is part of a nationwide rate increase request. We are filing for rate increases because some of the pricing assumptions for these guaranteed renewable products, although they were based on the best information available at the time, have not been consistent with emerging experience. We have seen more people going on claim and claims lasting longer than originally assumed when these products were priced. We have also seen people holding on to their policies longer than originally expected when these products were priced, which results in more policies reaching an age when they need care and go on claim. The emerging experience is worse for policies with longer benefit periods, which is why the rate increase request is larger for longer benefit periods. We understand that this request is greater than the required annual cap of 15%, but we want to be transparent regarding the company's rate increase plans with our policy holders and inform them about future rate increases up front. We would like the opportunity to work with the MIA where the rate increases would be phased in over multiple years at no more than 15% per year. Based on our experience, we could justify higher rate increases on these products than what we have requested, but we strongly consider the impact rate increases have on our policyholders. The full requested rate increase is approved and implemented. The company does not currently intend to request any additional rate increases on these policy forms unless experience worsens, and we will guarantee not to increase the revised rates for 4 years. If the requested premium levels are approved, they will still be lower than the rate increase requested on these products nationwide, and will also be lower than what it would cost to purchase a long-term care policy in the market today. We take the decision to do rate increases very seriously and keep in mind the balance of financial losses of the business and the impact rate increases have on our policyholders throughout making this decision. This business has loss ratios in excess of 100%, which means we're expected to pay out more in claims than we have received in premium over the life of the policy form. This shows that the company is sharing in the losses of this business. We do realize rate increases are difficult for our policyholders, but making these adjustments will help ensure policyholders will have these much needed benefits in the future. Our highest priority is to fulfill our commitments to our policyholders. To help policyholders that may not be able to afford the higher premiums or choose not to, we are offering several options to reduce the impact of the rate increase, such as reducing their benefit period or benefit amounts, canceling their benefit increase rider, or lengthening their elimination period, among others. Policyholders that choose to reduce or cancel their benefit increase riders will maintain all of their past accrued benefit increases to date. Lastly, for policyholders no longer wanting to pay premiums, instead of losing their entire coverage, we are offering a paid-up benefit typically equal to the premiums that have been paid into the policy. Nationwide, we've seen in the low single digits elect this option, which highlights the value still seen in the product. We have started providing our policyholders access to a cost of care website. The cost of care website provides average LTC costs across the country so policyholders can make more informed decisions about how much coverage they'll need. Encourage any affected policyholders to access the cost of care website and to call our contact center for any assistance with understanding the options that are available. Our contact center is fully trained on LTC products, rate increases, and the cost of care website. The contact center will be able to walk through the options available to policyholders and the cost associated with each choice. In our experience, the vast majority of policyholders impacted by a rate increase have decided to maintain their current benefits and pay the increased premium, and this is in line with experience across the industry. Nationwide, we have seen around 15 to 20% of policyholders elect to reduce benefits on recent rate increases. Policyholders see the value in long-term care insurance to cover future long-term care needs. It can be very costly and deplete retirement savings very quickly. Thank you again for providing Allianz Life the opportunity to speak today, and thank you for your consideration on our filings. We'll open it up to questions.
Thank you, Scott. I have a couple questions. So you mentioned that there would be a 4-year rate guarantee. So just so I'm understanding this correctly, some of your rate increases, the 65% for lifetime benefits on the generation protector would take 4 years to phase in. So you would be giving increases from 2021 through 2025. And then you're saying that 4 years after that, you would not increase the rates.
How we've administered that guarantee is it would be from the start of the very first implementation. So we would do like the 4-year stage, and really the guarantee would be that there'd be no other increases during that 4-year time span. So it does not apply like after the stage increase is over. That's something we can talk about. Yeah.
All right. Thanks for that clarification. And then you say that you would not intend to file future increases unless the experience worsens from its current level, that if the experience stays at its current projection, that there wouldn't be future rate increases sought?
Yeah, that's our plan right now. We want to be transparent about our future plans. Our plans right now, if experience does not change and this increase is approved, we would not request any additional increases.
Okay. And In the 5885 calculation in your memo, you note that there's a 10% margin for adverse experience.
Yep.
Is that 10% margin in all your loss ratio projections in the filing, or some without margin and some with margin?
Yeah, so it's just included in that 5885 calculation. So I don't know if you have the memo in front of you, but we have other exhibits like exhibit 3 through 6, which are loss ratio projections. Those do not include any margin.
All right, that's helpful. Thank you.
Yeah.
This is Jeff. So my question, I'm gonna follow up with Brad's question for 4-year rate guarantee. So if MI cannot grant the full requested rate increase, can you consider some rate guarantees for certain periods? Maybe not entire 4 years.
Yeah, we would definitely consider that. And that's, I think, been consistent with how we've approached other filings with Maryland too. So,
Okay, thank you.
yep.
Adam, did you have anything, or David, anybody else on the MIA team? I didn't have anything. The question that I had really was about that 4-year guarantee and when that would start, but you clarified that. So thank you very much, Mr. Laska. I appreciate your presentation today.
Thank you.
And we will now hear from Genworth Life Insurance Company with regard to both its individual and its group filing. And here on behalf of Genworth is Alex Vichinsky. So Mr. Vichinsky.
Thank you. Good afternoon. My name is Alex Vichinsky, and I am an actuary in Genworth's long-term care in-force business unit. I am in good standing with the Society of Actuaries and the American Academy of Actuaries. Commissioner Birrane, thank you and the Maryland Insurance Administration team for holding today's virtual hearing and for providing Genworth and our policyholders an opportunity to discuss our long-term care insurance policies. I'd also like to thank all of our policyholders for your interest and participation. Genworth understands that your long-term care insurance coverage is important to you, so we welcome this opportunity to participate in this hearing. During this unprecedented period, Genworth understands that our ability to support, service, and protect you, our policyholders, is of absolute importance. We take this very seriously and affirm our commitment to being there for our policyholders when they need us. Genworth has been selling long-term care insurance in the state of Maryland since 1978 and currently provides coverage for approximately 29,000 Maryland policyholders and approximately 1.1 million policyholders nationwide. I'm here today to speak specifically about our current long-term care premium rate increase filings, which are pending with the Maryland Insurance Administration. Genworth understands premium increases can be difficult for our policyholders, so we are committed to providing information that explains why rate increases are needed. We also want to discuss the various options we offer our policyholders and the ways we assist each of you to make informed choices about your specific LTC insurance needs. Genworth is currently seeking rate increases on an individual product issued between 1988 and 1994, as well as the first rate increases for certificates issued between 2010 and 2013 under a newer group policy form sold to AARP, an association group. So to be clear, when I use the term policyholder in my remarks today, that reference also includes certificate holders in the case of association group product. When we price these policy forms, we utilize professional actuarial judgment to develop assumptions that look forward as many as 60 years into the future. Genworth employs our best efforts to complete a thorough professional assessment at the time of original pricing and as we evaluate the blocks on an ongoing basis. Since 2010, claim information, which informs our assumptions, has more than doubled for Genworth. We have seen that claims continue to cost more and occur with higher frequency than originally anticipated. Yet, we are sensitive to the impact these rate increases have on policyholders, and Genworth is sharing in the cost of these rate increases. Genworth has experienced approximately $3.6 billion of losses on LTC legacy blocks cumulatively through year-end 2020, and will continue to experience significant losses on these lines of business. We have stated that we have no intention of taking a dividend out of the companies that hold these policies. These blocks of business are being managed solely for the benefit of policyholders, and these rate actions will go directly to support the claims paying ability of the company. While information on claims for newer products is still developing, such as this association group policy form, we have leveraged our experience data to inform our assumption setting. For the assumption supporting the association group rate increase request, Genworth leveraged significant new claim experience on similar and related product series. It is our intent to act in a timely manner and work diligently with regulators to obtain approval for the proposed rate increases, as we seek to avoid more significant premium rate increases on newer blocks that would otherwise be required when the average attained ages are higher. I also want to highlight some of the COVID-19 related considerations that have impacted the long-term care industry and Genworth. Given our industry, we are uniquely positioned to understand the devastating impacts of COVID-19 on some of the most vulnerable in our communities, older adults. Considering our average claimant is in the early 80s, we appreciate that this particular population is at high risk for contracting and suffering serious effects from the coronavirus. Genworth implemented a comprehensive COVID-19 community outreach plan to assist those most challenged in our communities. We initiated outreach to local nursing homes and assisted living facilities and created programs to respond to social isolation among seniors. In addition, the Genworth Foundation has made contributions to safety net organizations in the communities in which we have offices, many of which provide care and services to the elderly. As a global organization, Genworth has created and maintained business continuity plans across all of our businesses. Despite the changes we have made to our operations due to COVID-19, careful planning has allowed us to continue the operation of critical functions, including policy administration and, most importantly, payment of policyholder claims. Overall, Genworth has observed what is believed to be a temporary decrease in new claims, potentially due to reluctance that some policyholders feel about moving into facilities or receiving outside care in their homes. Publicly available information indicates that this is an industry-wide phenomenon. We believe that incidence is likely to return to pre-pandemic levels in the future. In fact, we've recently started to experience a gradual increase in new claims. COVID has accelerated a shift from facilities to home care services. We believe this increase was induced by concerns over well-publicized COVID-19 infection rates in LTC facilities. Although we are seeing lower incidence, which is the number of claims initiated, as well as shifts to home care services, recent home care experience metrics show higher benefit utilization, which is the amount of the total available benefit being used for these newer claims relative to historical levels. While the ongoing impact of COVID-19 is very difficult to predict, the related outcomes and impact on our LTC business will depend on the length and severity of pandemic and speed of economic recovery. There is significant uncertainty as to the long-term impacts of COVID on overall morbidity and on the health of the general population. We have not changed our long-term assumptions based on recent COVID experience. We continue to track business performance to help refine our expectations, but it remains too early to tell how recent trends may impact longer-term financial results. LTC is a very long-term product, and as I previously mentioned, we project premiums and claims over a 60-year period. Events in any given year, while tragic in and of themselves, are unlikely to materially change overall projections for the future. Genworth's #1 goal is to ensure our claims paying ability for all of our policyholders. Actuarially based premium and rate increases or policy adjustments are an important component to achieving this over the life of these policies. As it relates to the specific rate increase request at this time, our pre-PCS product series includes the following policy form numbers: 50,000, 50,001, 50,003, 50,018, 50,020, 50,021, 50,022, and 7021. We are seeking premium rate increases of 101.1% for policies with lifetime benefits only. Acknowledging Maryland regulation, Genworth would be willing to implement the requested rate increase over 5 years with no more than a 15% increase in each year. This rate increase will impact approximately 300 policies. These policy forms have received 5 prior rate increases, which were implemented so that no increases exceeded 15% in any applicable year. On the pre-PCS product, we will not make money on these policies. As such, we are absorbing a significant share of the cost of deteriorating claims experience. Genworth issued a master policy to AARP, an association group, on policy form 7050. Certificates that were issued to Maryland residents under that master policy on certificate form number 7050 CRT from December 2010 through October 2013. We are seeking a premium rate increase of 103% for all certificates. Acknowledging Maryland regulation, Genworth would be willing to implement the requested rate increase over 6 years with no more than a 15% increase in each year. This rate increase will impact approximately 1,200 certificates. Impacted certificate holders have not received any prior rate increases. On this association group product, Genworth will continue to evaluate whether additional rate increases will be needed as experience emerges. Premium increases can be a tremendous burden for our policyholders. We know this because we talk to our policyholders almost every day. To support our policyholders, we have a dedicated team of specially trained customer service representatives whose sole responsibility is to take calls related to rate increases. Our customer service representatives are ready and willing to help our policyholders understand their options so they can determine the best course of action for their individual situation. We also have a website that provides policyholders with helpful information on why increases are needed, options they may have, the value of coverage, and frequently asked questions. We continue to offer policyholders subject to a rate increase a variety of options. They can choose to pay the full amount of the rate increase and maintain the current level of protection. From our overall nationwide experience on the rate increases we have implemented since 2012, even with the variety of options provided, we have seen approximately 62% of our policyholders choose to pay the higher premiums as of December 31st, 2020. Or, instead of paying higher premiums, our policyholders can make custom benefit adjustments to find the right balance of affordability and protection for their individual situation. For policyholders who no longer can afford or want to pay any future premiums and who do not otherwise qualify for another option to maintain the policy while ceasing to pay premiums, we voluntarily offer a non-forfeiture option that equals a paid-up policy. With this option, if the policyholder becomes claim eligible, Genworth will reimburse eligible expenses up to the amount of premium paid, minus any claims that we previously paid. In addition, a policyholder will still have access to the care coordination services that our company provides. I hope that the comments today have demonstrated that Genworth actively manages our business to try to ensure that we will be here for our policyholders when they need us most. To make sure we are available to provide the answers you need and to pay eligible claims if and when those needs should arise. To date, Genworth has paid over $22 billion to our policyholders on more than 300,000 claims for eligible long-term care benefits. Genworth is committed to keeping our promises to our customers and paying all eligible claims. But again, actuarially based premium rate increases or policy adjustments are an important component to our ability to do so over the life of these policies. Genworth is in a unique position relative to other carriers with a material LTC concentration. Almost 60% of our total reserves back LTC liabilities, and this number is projected to increase to roughly 65% by 2023. Any reserves that are released due to policyholder elections, including elective terminations or reductions in benefits, are used to support the LTC business. As I previously noted, GLIC does not intend to use any capital or collected premiums for anything other than supporting the claims paying ability of the company. Genworth Financial has publicly informed its investors on multiple occasions that it does not anticipate that Genworth Life Insurance Company will pay any future dividends to its parent. And in fact, there hasn't been a dividend from Genworth Life Insurance Company since 2015. In conclusion, Genworth remains committed to working with the Maryland Insurance Administration to implement actuarially justified rate increases in a reasonable and responsible manner, keeping in mind policyholder interests and concerns. Commissioner Birrane, Genworth appreciates the opportunity to participate in today's hearing. I would be happy to answer any questions from you or members of your team.
Brad? Having trouble unmuting.
Yeah, sorry, I was having trouble unmuting. Thanks very much for the testimony, Alex. I do have a couple of questions. So the two filings you submitted are almost polar opposites. You know, one's extremely old, and one's one of your newer blocks of business. With respect to the older block, the pre-PCS business, you know, I'll note that, you know, 97% of lifetime premium is in the past. And these rate increases are applying to the 3% of premium in the future, and that even though you're requesting 101% increase, doubling the premium, it's having less than a 1% impact on the lifetime loss ratio, and it's still leaving the lifetime loss ratio well above 100%. And no matter how many more 15% we approve, we can approve them from now until all the policyholders have lapsed. You're never going to get this product below 100% loss ratio. So my question to you is there a point where the premium runway becomes too small and or the cumulative increase given becomes large enough that you're going to stop requesting increases and say, this block is done and we're going to accept the results as they are? And are we at that point with these proposed increases, or do you anticipate even further increases in the future?
Yeah, thanks for the question, Brad. I'd start by agreeing with your statement that on this oldest block, it is somewhat of a polar opposite to the newer block, which also has a submission. And as you acknowledged, the premium runway is very small, and we had identified that when initially developing our rate action plans for all of our blocks of business. And I'd like to state that our overall approach is to not have a uniform approach across each block of business, rather to manage the block as a whole. And with that, taking into considerations the unique features and situation of each block of business. So with that in mind, on these older blocks of business, I do think there's a much more limited capacity for any future rate increases. Currently, this request is consistent with our original plan developed approximately in 2015 for this block. We have no intentions of adding future rate increases beyond what's in this filing for this block due to the age and limited premium runway, as you mentioned. However, on newer blocks with significantly more premium runway, lower attained ages, we will continue to monitor experience and act accordingly if further justified rate increases emerge.
Okay, thank you. And one more question about this block. Have you had the chance to analyze the COVID impact for these very old blocks separately? Even if any increased mortality, for instance, is temporary, it's a greater share of the entire future projection for this pre-PCS block than it is for a newer block like the ARP. So have you looked at how COVID is specifically impacting these very old closed blocks where the average age, I think, is as high as 88?
Yeah, thanks for the question. I don't have that data right now. I can get back to you on that regarding, specific analysis on this pre-PCS block or any of our older blocks. I will say generally that, we did see a slight uptick in mortality across our whole block of business. But as that data is starting to cure and we're continuing to do more analysis, we're happy to report our findings to you and in our conversations.
Yeah, that would be appreciated. And then I had one major question on the AARP policy. I know it's group versus individual, but this policy was being sold from 2010 to 2013, and by the time you were pricing this policy, you had enough pre-PCS data available that you knew the rates were inadequate and needed to be increased, and you started increasing pre-PCS. And so to what extent was updated assumptions, in this initial policy based on that experience, and what assumptions still did you not have insight into back in 2007 to 2010 when you were pricing this, and which assumptions are specifically missing the mark on this newer policy that are driving this overall 103% request?
Yeah, that's a great question, Brad. I apologize. I'm getting a bit of an echo. I'd say that the key assumptions that are driving the need for the rate actions on this group form are more centered around morbidity. I'll say a lot of the initial rate actions on pre-PCS and older blocks, let's say, 10 years ago or before the multi-year rate action plan. We're largely centered around lapse and mortality. I'll say, as you know, we've made assumption updates over time. Those are much more stable, and recent assumption updates have been much more centered on the morbidity components, including incidence, utilization, and claim termination rates. I'd be happy to follow up with a more detailed breakdown on this specific group filing, but that's generally the key assumptions involved in this group filing.
Yeah, thanks. That's helpful. And yeah, I would appreciate a follow-up with more detail. We can talk either via surf or we can have a call together. But yeah, that would be good information to have for this review.
Sure.
Alex, this is Jeff. I have two questions. The first one is for pre-PCS. I look at your entire country, history of rate increase requests, and I notice in California, your cumulative rate increase in there is 90%, while it is 105 in Maryland. And on the chart you provided to us, I could not find you have recent rate increase in California, but you have, as I said, less cumulative rate increase there. So can you explain why?
I'll have to look into the circumstances of the pre-PCS block in California, but in general, our approach is to develop a nationwide strategy and plan for rate increases and pursue those equivalently across all jurisdictions. So I would have to look into the circumstances in California to see if a pending filing is upcoming. But as you can see in the data you have, the vast majority of states are well above that level of Maryland or California. Many of them have completed our multi-year plan, which is within the current filing.
Okay, I just feel California is big. You may need to focus on that state. So, okay. My second question is for the group fighting. So you built in 15% moderately adverse experience for that fighting, but I was not able to see that for the pre-PCS fighting. So am I right? You don't have the MAE built in for pre-PCS fighting?
Yeah, that's correct. The pre-PCS block is a pre-rate stability block, just given the age, and it doesn't require the moderately adverse condition. Furthermore, as Brad alluded to, on this block, we're not even coming close to approaching the originally priced for loss ratio, so that the MAE wouldn't really come into play. Again, that block, the 100% lifetime loss ratio is never going to be reached, and it's in a locked-in loss position.
So per your saying, you mean your recent products, like maybe Choice One, since from Choice One, you have MAE built in?
It would, yeah, any product Choice 2 or newer would fall under the rate stability provisions. That's contingent on each state's approval of or adoption of the rate stability regulation, but that's generally how it works.
Okay. Do you use 10% in original fighting if you have MAE built in?
The original filing was not explicitly a 10%, is my understanding, but what we've learned in recent years is that a 10% margin has not been sufficient to absorb some of the assumption updates that we've seen in recent years. So we thought it was prudent to shift to a 15% margin on these newer blocks in hopes of truly providing some level of rate stability.
Okay.
And on that topic, Alex, I'll say I definitely support a 15% margin, going forward for a new product. I will say for this group product and review, I have some concerns about changing from an original 10% margin, increasing it to 15%. I'm not sure if Jeff's put a request in SURF yet, but I was wondering if you could provide us the loss ratio exhibits from the filing as an alternative version with the 10% margin to see how much, impact that increased conservatism is having on the recommendation?
Yeah, we would be happy to provide that.
All right, thank you.
Thanks.
I think that's everything from the Office of the Chief Actuary. Adam, you don't have anything, right? All right, thank you very much, Alex, unless you have anything further, Commissioner.
No, I did not have any questions with regard to these particular filings.
Thank you for your time.
Thank you. So that brings us to the conclusion of the agenda that we have scheduled. As I indicated, we did not have anyone sign up to testify or to speak today, and we did not receive any advance comments. If there is anyone who is on the line, we have a handful of attendees beyond the panelists that wants to be heard. As I indicated, just let us know in the chat function. Craig, I don't see anyone who's asked to speak.
No, I'm not seeing anyone.
Okay. So having not had anyone request to speak, I think that will conclude our hearing. I'll just remind everyone and anyone who's watching this tape and accesses it on our website that we will hold the record open until August 18th to receive any additional comments. They can be posted on our website. And if that's confusing, please feel free to email Mr. I at the email address that he's provided in the chat box, and he will help you to post it. So with that, I want to thank everybody who participated today, and that will conclude this rate filing hearing. Thank you. Take care. Be safe.